Good afternoon, everybody. JD here with your Rational Trader Market Analysis Daily. In today's video, what comes next? Well, there's peace in the Middle East. The Federal Reserve is going to do what it's going to do, cut interest rates at some point. The big, beautiful bill is passing, and the economy is growing at a above potential rate. Corporate profits are rising, and expectations are for a really strong second quarter earnings season. And in response, stocks are now trading at historical highs. So it might be logical to say, okay, what comes next? Well, whenever I'm faced with that particular question, I always lean back on my four pillars of rational trading. That gives me a great macro foundation to ascertain market direction in the near or short term, anywhere from a day to the next 30 to 60 days. So we've been really on track and on a wave here up to these historical highs that has been relatively obvious and easy to trade. I think things get a little bit more difficult here. I mean, this is going to sound horrible, but I really did expect more turbulence and dislocation in the market. Dislocations, by the way, are good. Read up on Adam Smith, the grandfather of modern economics in The Wealth of Nations. He talked about the business cycle and the business cycle being healthy. Well, dislocations in the market are very healthy as well, painful to go through unless you're obviously prepared for them. But they set the stage for what comes next. And absent that dislocation, like I said, it just makes it a little bit more difficult to ascertain where we're at. Now, if I look at the four pillars, front and center valuations, I think we can just throw that right out the window because in this market environment, valuations give you zero insight into the appetite for investors. All you need to do is look at Bitcoin, and I'm not going to say any more about that. Okay, so pillar number one doesn't help us. Pillar number two, the volatility index, and the volatility index is falling, although we're not getting a lot of clues from that either because the investors in short or long volatility are very, very, very skeptical of a volatility index that is below. I apologize for that. I'm getting drowned out by a motorcycle. Anyway, such is the nature of summer here in the frozen tundra. Anyway, so the volatility market, if you will, is very nervous about a volatility spike. And because of that, the predictive power of the volatility index is less and less. What I need to see with volatility before I can trust volatility is a decline down to 15 and trading below 50 on the volatility index for 30 to 60 days. When I get that, I think the dislocation in the various long, short exchange traded funds can then now offer some insight into where we go in the market, but that doesn't help me today. The next indicator is the yield curve. The yield curve is upward sloping and suggestive of the strong growth that GDP now is predicting for the second quarter. So there's good news there, and we can ascertain that just because we're at historical highs doesn't mean we can't go higher. We absolutely can go higher. So the fourth pillar is the one I'm going to rely upon the most in looking for clues as to the immediate term and the next week or two of trading. If I look at the NASDAQ look how far we are above the 200-day moving average. And actually, the 50-day moving average is only a couple hundred points below the 200-day moving average. So those two lines are actually going to cross here at some point, the longer we stay so elevated in our trading. But at 18,400 on the 200-day moving average, we are well over 1,400 points above the 200-day moving average. So uh, I would call that a ceiling. It's not, again, that we can't go higher, but it just, we don't trade at these levels for very long. And so uh, that to me is an interesting um, observation that I'm going to make regarding the market. Same with the S&P 500, well above the 200-day moving average, and today's pop, if you will, puts us some 300 points above the moving average. And then finally, where it gets a little bit more interesting is the Russell 2000. So we're in this vacuum of information right now that we don't have earnings season. The geopolitical stuff is now on the back burner for now. Just go with that. I know there's some issues that we have to deal with, but the market for now is putting those geopolitical issues on the back burner. You can see the last time the Russell 2000 bumped up against the 200-day moving average, we tested it and dropped 75 points. Not a huge drop. And I suspect, we're getting close to that point where we're either going to bust above the 200-day moving average or we're going to fail another test and then drop back down here to 2100. Again, it's not crystal clear. I can make a case for a slight bias to the upside. I can make a case now that we're at these historical highs, a slight case for a gentle drift lower. Bottom line is it's been a heck of a run, and I wouldn't argue at all with some profit taking here. What I'd really like to see here, again, this is why dislocation is so important. We're just back in that pattern, with the Russell lagging here, not trading above the 200-day moving average, but the Nasdaq and the S&P so far above the 200-day moving average. It's just telling you that those Mag 7 type technology, AI related stocks are working. Bitcoin is working. Small cap stocks, they're working, but not so much. Personally, I'm okay with that. It's not the most healthy thing for the market. So I'm pointing it out so that you're all just aware of it. And the good news is these are the observations that I'm making. And what ultimately really matters are the individual stocks as we head into earnings season for the second quarter. Keep an eye on those two sigmas. I'm using that really quite a bit and going from there. That's all I have for today, folks. I'll be back with another video tomorrow. This is JD for The Rational Trader. Take care, have a great day, and we'll see you next time.